name is Julie, and I have the pleasure of facilitating today's meeting. And trust me, today is a day we all want to get on board for. Like, this class is priceless. Some people get to pay for it. And I can tell you from experience, some people get to pay for this training to get this knowledge that our speaker will be giving to us today. So today we are looking at the tax preparation practices and tax updates for 2025. So it's that time of the year when you want to check your books, you want to check if you are in compliance and a whole lot of other things attached to the IRS especially. So our guest speaker for today is Mr. Cyril Ogbesetuyi. He's a CPA, that is a certified public accountant in the United States and a chartered accountant in Nigeria. He also holds certifications in internal audit and information technology with the CIA, CISA, CISM, CRF, and he earned his MBA in accounting from Texas Women University and bachelor's degree in accounting from Ekiti State University. So Mr. Ogbesetuyi is the principal consultant of LKB CPAS LLC in Dallas, Texas, a firm he founded in 2012 that specializes in tax preparation and planning, accounting, payroll, insurance brokerage, and business consulting, which covers formation, reviews, and compilations. So it's such a pleasure to have Mr. Cyril today. Sorry, pardon me, please. It's such a pleasure to have Mr. Cyril with us today. And he's going to be digging deep into a lot of information for us. So once again, I would enjoin us to welcome Mr. Cyril on board. And please, most importantly, let's get our notepads and our pens ready for this lesson. He's going to be giving us a lot, but we don't have the time to cover all that he most likely has for us. So I would want us to please take notes and get questions ready for the Q&A sessions. And let's stay muted as well while the class is ongoing. All right, Mr. Cyril, the floor is yours.
Thank you so much, Ms. Juliet. Thank you for that brief introduction. I appreciate that. Yeah, I want to welcome everyone to the annual tax audit 2025. These are agendas for the meeting, introductions of my firm practices and procedures. Then we quickly run to tax update since we just have 1 hour to deal with everything. Then the question and answers sections just going to be about 15 minutes or 20 minutes maybe at maximum. The firm practices. So in our firm here, we take clients from all the 50 states, and including those that are working on asset expatriate internationally. So we do taxes in all the 50 states, because as a CPA, we don't have any restrictions on what we can do in business, in accounting and taxes, as well as auditing. So we accept clients from all the 50 states. And the procedures for collecting client data include through business email and WhatsApp channels, and they are secured and protected from non-business intruders. So once we get our client tax forms or tax files ready and they are prepared, we communicate their refund status information to them to secure their approval. Without approval of client, we don't transmit. So that means we have to be on the same page. Before we can transmit your tax return to the IRS. One more thing is that if we are entitled to a refund, we only deal with the through direct deposit. That means your refund can only go through direct deposit. We don't give you check here. So you provide your accounting information, and then we send your refund there. And that's the exact amount you meet after the IRS review your tax information and approve your refund. you are going to meet the same things. And you can even compare the information we provided for the refund information with what the IRS sent you. The only time where we can have discrepancies is if you are owing IRS, you have an obligations here with IRS. IRS may because of that, seize your refund or take portions of that refund and then they send you the remaining balance. So there's no cost going to the nature of our services since Ms. Julius are assisted with that. And then one more thing about us is that you can always reach out to us 24/7. Even in the middle of the night, don't hesitate. We'll put a call through us, we'll pick it. Yeah, and answer your questions, whatever it is that is business related. Okay, now let's discuss the filing statuses. Yeah, and this is the starting point for the start preparation. And the reasons why this the selection of filing status is important is it helps to determine whether your refund is going to be full or your refund is going to be short or you are going to be owing the IRS. So it's very important. It's key here in the tax preparation processes. There are a few statuses we have here, about 5, but only 4 of the statuses are relevant because the 5th one can be switched over as the head of household. So the first status is the single status, which implies this filer or this taxpayer doesn't have any dependent and is not married. And usually they pay the highest taxes in the United States, especially if they don't have any business on the side. Yeah, so they bear the highest tax burden. Next is married filing jointly. They pay the lowest. And the reasons why married filing joint pays the lowest is that because there are 2 people in that applications, maybe husband and wife or 2 partners, they are able to maximize their maximize all the credit that goes with that status. Yeah, married filing separately is the least beneficial for anybody that actually wants to do their tax return, especially if they are married. Yeah, because because all the credit for the dependent, if they have children, they're going to lose it. If they have any income, yeah, and then the credit that you go with is supposing the income level is low or the income is okay. The married filing separately is the least beneficial, and the reasons why I say that one is the least benefit. The reason why I say the married filing separately is the least beneficial is because one, the standard deductions, the standard deduction that goes with this one is just as if somebody is filing as single. Even though you are married, you are claiming the status married, which would have been beneficial for you. But because you are doing it separately from your spouse, you're not going to get the full benefit that goes with the status which I discussed above here as married filing jointly. Next to that is the head of household. A head of household will have a dependent. That is a tax filer with a dependent. A dependent could be an old parents. A dependent could be a child, a stepchild. And for somebody to elect the head of household, if I'm going to be claiming that dependent, the dependent, you must have a proof that dependent lives with you for 6 months. Because if IRS, you put your record and ask for the proof, you have to document it that dependent lives with you for at least 6 months. And the kind of document you have to present under such circumstances that you may have to approach the school that your dependent is attending to give you a note. If they give you a note and attest to it, or they validate it that the dependent is living with you, and for a minimum of a school term, if the school can give you that at least that dependent has lived with you for about 3 months to 4 months. But what the law
Yes, I'll come. Yeah. She did like so. She did
Let's mute our mics,
I
please.
feel like
She did what?
Everyone mute your mics, please.
But you know, see, once I walk for view, so like, no share, no
Is
YouTube.
MA Oyebade Ifeanyi, please, I need you all to mute your mics. Thank you.
Just as we are discussing the head of household status, that the filer that is electing these categories must have a dependent, and there must be a proof that such dependent live with the filers for minimum of 6 months. So if your dependent is your child, of course, you will have all the information, whatever the information the IRS may require from you. Yeah, you will have access to the social securities of your own dependent. You will have information report from their schools. And if they are not yet of the school going age, you have vaccination report or record that will show that, okay, if a child is not living with you, won't have that kind of information. You will have their birth certificate with them, and you may even have a copy of their international passport or a copy of American passport. Yeah, if such dependent is a U.S. citizen. But for U.S. resident, you may have to present international passport. That will provide to IRS. That is a full proof that such dependent is living in out. The fifth one, which is widower with a dependent, is for filer that loses their spouse during the year. So if a spouse has a dependent, and then in course of that year, they lose one of their spouses, widower with a dependent is the selections they can elect. And that is going to be at the end of the second year, not in the year of dissident. God forbid bad things if there are two partners living together, and usually in the previous years they let marry finally join, and something happens in course of the year, one of the partners died. So at the end of this year, the living partner can still let marry finally joined with his or her partners that was late in course of the year. Let's discuss tax credit, privileges that reduce your tax liabilities or increase your refund. So I decided to work on a few of these credit because there are so many of them. But I decided to feature only what applies to most filers. One among those credits is child tax credit. The maximum allowed for this new tax season we are going to be entering into is 2,200 per child. And if we make less than 400,000, and you, as for somebody letting marry finally joint, you are likely to get part of that part or whole of that child tax credit. And one more thing about the child tax credit is that the child tax credit doesn't really increase your refund. It helps to reduce your tax liabilities. The reverse side of it is that once your tax liabilities is reducing, then automatically your refund is likely to increase. And therefore, those one that elect other statuses other than married finally joint, the maximum income allowed is 200,000. So if somebody that elect head of household, still make or hand income that is less than 200,000 in a year, they are still likely to get the child tax credit. So additional child tax credit, this is the additional child tax credit help to increase your refund. And that is for those filers that have a dependent. To have dependent, and that dependent is under the age of 17 years, you are entitled to this credit, assuming that you meet the income requirement. And in determinations of additional child tax credit, it's not your total income that matter. It's your adjusted gross income. That means your income after itemizations have been taken from it, or standard deductions have been taken from it, and other above the line deductions. And therefore, somebody claiming additional child tax credit, the number of dependents you can have on your tax return is 3. So if you have 3 and you meet the income threshold, you are likely to get that is going to be 1700 or 1,700 multiplied by 3, assuming you qualify. That is for the additional child tax credit. Next is earned income credit. This also help us to help in increasing the refund of the filers during tax seasons. This benefits families with low to medium income. For those people electing single status, the maximum they can get for earned income credits is 649. Meanwhile, a filer with 3 kids may get up to 8,046, assuming they satisfy the income requirement and some other conditions. And some of the conditions is that the earned income credit, I think that is the main hub of the refunding and tax preparation processes. That produce the earned income credit produces the largest amount of refund component. But there are certain conditions that needs to be satisfied. One, the adjusted gross income and the number of eligible dependents. That is the first condition that needs to be satisfied. The second condition is age limit. If you are under the age of 25, you are not going to be entitled to earned income credit. And if by virtue of your number of years on earth, you are more than 65 years old, you are no longer qualified for that credit. Another condition is that you must have an earned income. Earned income are the incomes that you receive through wages and salaries, tips. Somebody receiving 1099 that is driving for Uber or Lyft. The kind of income they receive through their 1099 is also considered earned income. So they are entitled and they may qualify for that kind of credit, especially if they have dependents. Another condition is that you must be a resident for 6 months. But if we let marry filing separately, you are not going to get, even though you meet the income threshold and everything, and then the age requirement to satisfy it, you satisfy the residency. But if we let marry filing separately, what we will get is going to be 0. So that is a die service for those people that normally let marry filing separately. And then your investment income during the year must not exceed 11,960. If you have $1 over that, you are not going to qualify. Now, let's go to education credit. There are two sets of credit for schoolers. One addresses a portion credit to those ones that are doing undergraduate studies. The second portion, and that is the American Opportunity Tax Credit. If you are doing undergraduate and you are more than 18 years old, you are qualified for the American Opportunity Tax Credit, and the maximum you can get at the end of the year is $1,000. You don't really need income. So I think at these junctions, if we have children that are going to college and they are doing undergraduate studies, they can easily qualify for these credits. It's $1,000 that will go into their pocket, and they can claim it for that 4 years. But if you don't claim it, you lose it. And you don't need any income to claim that credit. You just need a proof of college attendance that you were in college at least for a period of 6 months, or that you have taken at least 3 or 4 courses during the year. Life learning credit. Life learning credits is for those ones that are doing postgraduate studies from master upward. But one thing, there's a gray area between those that are qualified for American Opportunity Credit and Life Learning Credit. For somebody completing an undergraduate studies in May, and by September they are going for their postgraduate studies. Even though they started their graduate studies, they are still qualified for American Opportunity Credit because that was the year that their undergraduate study ended. The Life Learning Credit, just as I said, is for those ones pursuing the graduate studies, master's, PhD, other postdoctoral programs. This credit only helps them to reduce their tax liabilities, assuming they are working and they earn income. So the Life Learning Credit helps to reduce their tax liabilities, but doesn't really give them any refunding opportunities. That means they can't receive a refund. Yeah, because they are claiming Life Learning Credit. It's substantially different from American Opportunity Credit. Okay, next is the child and dependent care credit for those ones that have children under age of 13, and those children are under the care of they hire somebody to provide child care services. The number of credit, the amount of credit allowed for one child is 3,000, and the maximum that is available for two or three children is 6,000. This does not translate that 6,000 will be added to your refund, or 3,000 will be added to your refund for those ones that are actually qualified and they have one dependent. But you can get a portion of what is allocated as credit for each category, depending on the number of your dependents. And then before you can claim child dependent care credit, the provider shouldn't be an auntie or a niece who does not have EIN number, employer identification number. Yeah, because if you claim it and then you are sampled out and you don't have a proof, yeah, it can be, yeah, we all know the implications of that. So somebody who is providing service must have the EIN number, must have a valid address, and must have furnished the amount you actually paid during the year to them with the IRS. That is for child and dependent care credit. There's another credit that used to help filers in the past, which is the clean energy credit, especially for those people buying a solar, or they have a home energy improvement, or they bought electric vehicles like Tesla. Those credits were available, but this year the new tax bill actually put an end to their existence. They were all terminated. So, which means by 2026, which is going to be a tax period for the 2025, if I just buying Tesla today or any EV, yeah, if you bought them after September 2025, you are not going to be entitled to the credit. In the past, if you buy Tesla, you're entitled to credit of about 7,000 if you are buying it new, and if you buy fairly used, it's 3,500. But those credits are no longer there. Okay, now condition for claiming a child on your tax return. Such dependent must be under the age of 17 at the end of the tax year. Be your son, daughter, foster child, stepchild, half brother, half sister, or nephew. If your dependent does not belong to any of those classifications, yeah, you may have to think twice before claiming such person as your dependent. Another condition that needs to be satisfied is that the dependent must not have provided more than half the support needed for the year. And you must have claimed that dependent on your tax return. The dependent must be a U.S. citizen, a U.S. national, or U.S. resident aliens. why your tax returns is delayed. I just put a few of the conditions that may warrant you having a delay in your refund here, but there are so many other ones. Incomplete income reported. So if you have any of your W-2 missing, because usually your employer, when they are preparing your W-2 at the end of the year, they usually prepare it in triplet. One will be given to you as an employee. Then one will be sent to IRS. Then another copy will be sent to Social Security administrations. And the information on those three triplets must be compatible. If there's any differentials in those informations, yeah, your refund may be withheld. Bogus or outrageous expenses or deductions. Duplicate Social Security number, identity theft. Sometimes if you delay in filing your tax return, some guys may have filed on your behalf and they have taken the refund. So by the time you are filing yours originally, you can't get the money again. By the time you contact the IRS, they may ask you to paper file because you can't submit electronic tax return, original tax return twice. And if you paper file, there's no likelihood you may get it. Incorrect or inappropriate credit. Fuel tax credit, you see people claiming fuel tax credit and their business is not qualified or eligible. Expenses for military. There are people claiming certain expenses that are only meant for military. And then we told these differences. The taxes on your social securities, the taxes on your federal income, withholdings, social security withholdings, and Medicare must match the kind of document IRS receives from your employer. Any mismatch will delay your refund, and you may not even get that refund. Changes in social security number, the same name, but different social security number. The new social security number has not been communicated to the IRS. These are some of the reasons why refund may be delayed or why you may not get the refund. Okay, now for the 401k contribution limit for the 2026 401k plan, as well as 403B and 473, for those electing married fining joint, the maximum they can contribute towards their 401k for the year starting January 2026 is going to be 24,500. But if they are filing as single, they can only take half of that, half of 24,500. In 2025, it was 23,500. That means they just added $1 on top of that. Limit on annual contributions to an IRA. We have an increase of $500 added to it. But in the previous years, which was 2025, it was just 7,000. And then for those ones that are for people over the age of 50, they have additional privilege. They call it cash up provisions or cash up contributions. And for the cash up contribution for those that are over the age of 50, apart from the 24,500 that we have here for married filing joint, a filer who is over the age of 50 can have this $8,000. So that means if they let married filing joint with their spouse, it's going to be 8,000 multiplied by 2. So, and then when you add this to the 24,500, you see how much they've saved. That will not be taxed for that same year. But for filers over the age of 60, up to 63, they can contribute additional 11,250 instead of 8,000 above. So if they are still working and they are over the age of 60, but they are under age of 64 4 years, so their cash up contributions is 11,250. So once they let 11,250 they can't have the cash out contributions above, which is 8,000 for those people who are just over the age of 50. So both contributions are in addition to the 24,500 deferral limit for 2026. And for all these things that I've mentioned, the advantage is that once you contribute, once you make these deferral contributions, the amount you contributed is not taxed for the year of contributions. But if you are withdrawing later, especially if you are less than 60 years, I think the threshold is 59.5 years. So if you are less than that 59.5 years old, yeah, you'll be penalized for early withdrawal. And then for the tax that you have not paid on it too, that is another 10% charges. So making totals of 20% that you'll be paying if you are drawing money below the age of 60. Okay, common tax changes in 2025 under the One Big Beautiful Tax Bill. One of the provisions is the Trump Account Pilot Program, which is 1,000 for each child born between January 2025 and December 2028. The maximum amount that parents can contribute to that fund is 5,000. But if we open that account, the account is not yet available. Opening is not yet available until January. But as long as that by January, if we have any dependent or child that is qualified, I will advise that you open that pilot program account for them, so that the IRS can pay $1,000 into it. But as parents, if you want to bulk it up, the maximum contribution you can make towards it is 5,000. And then at the end of Trump administrations by 2028, whatever you have in that account, you can roll it over into an IRA. Okay, next, tax credit for purchase of vehicles terminated. I think I've discussed that 7,000 now is now lost on the new car, and 3,500 lost on the used car. So that terminations, that occur under the One Big Beautiful Tax Bill. Although if you have a business, for example, if you buy EV vehicle and then you are using it for business, of course you can still write it up, depreciate it in 1 year, or depreciate it a couple of years. The EV credit is the only thing you are going to lose. Okay, and then for the state and local taxes, increase temporarily to 40,000. So this is advantageous, especially for people that have properties, because in the previous year, the maximum you can claim under for your property tax is 10,000. So if you are paying more than 10,000 for your property tax now, as long as it's less than 40,000, you can claim it as a deduction under your itemization, or if you have a business, you can claim it under your Schedule C. So despite this increase, the new tax law says by 2030, this 40,000 that will have an annual increase of 101% on it will revert to what it used to be before this new tax law. So it's going to be reverting to 10,000 by 2030. So the part of the new provision is the card loan interest deduction. So if you bought a vehicle on credit and you are still paying on it, or you intend to buy a vehicle, and you'll be paying on it, the credit deductions on your vehicle that you can claim whether you itemize or you don't itemize is 10,000. So, and I think that is advantageous for people that are still serving their auto loan, or those intending to buy autos. Tax on overtime is reduced by 12,500. That means what we are collecting as overtime now is 50,000. About 12,500 out of it will not be taxed. Same tax on tips, reduced from the first 25,000 you made that as a tips will not be taxed. So for those people who owe the nature of their
Okay.
Daddy, you should be on mute.
I can mute it or
Always be on mute when you're on video.
okay.
Okay, let's continue. Tax on tips. The first 25,000 now is excluded from taxes, subject to modify adjusted gross income. So if what you are making is less than 150,000 for a filer, you have that 25,000 off here to your tax bill. And if what you are making as married filing joint is less than 300,000, yeah, the same thing applies to you. The college saving plan, section 529, can now be used for other work-related and professional credentialings. For example, if you want to write professional examination or you have a dependent writing that exam, yeah, because 529 is still towards college education before. Now you can now use it for other things, including apprenticeship. Okay. Sometimes we may have done something not with intent of not with intent that we something that we are not doing it intentionally. Maybe because of the type of person we marry. For example, if you are married to somebody who has a past high IRS obligations or owing past child support or alimony, and then you married with that kind of person during the current year, the IRS will not going to save you because they don't really have any knowledge of you. Whatever you have, if you are entitled to refund at the end of the year, IRS will take it because of your spouse obligations. But the savings grace, the savings grace is that if once you detect that one happens, is that you can file your innocent spouse or enjoy spouse applications with IRS, whatever that is entitled to you or whatever that you are supposed to get as your refund. Yeah, they will prepare it, apportion it over there, and send it to you. For the Social Security, the administration, just like what I said. So Social Security Administration's account. Please, I will advise that if you can just make it, if you can create the account on Social Security Administrations so that you can watch what the employer is contributing or what the employer is submitting on our behalf. Sometimes what they submit is always shorter than what we have on our W2. So I will advise that at the end of the year, open that account if you don't have access to it, and then check what your employer reported on your behalf. You can check your Social Security income and match it with what you have on your W2. If it's short, then you can draw the attention of your employer to it. But because if you don't draw it, the IRS will only the Social Security Administration will make determination based on what your employer, present or past, they submitted on your behalf. And they will use that one to determine what you are entitled to by the time you turn 62, which is going to be your Social Security share. So if you don't go after them, yeah, nobody, yeah, they may not help you out. Yeah, because they can only work with what is reported to them. And you note that the maximum amount you need to contribute here to be eligible for Social Security Administration is 40 units. So by creating that account, you'll be able to monitor it too. If you have less than 40 units and you are thinking of about retiring, you can quickly work to bulk it up and make sure you meet the 40 units before you retire. I think yeah. So now for the standard deductions and itemized deductions for the years, the standard deductions for those that elect marry filing joint is 31,500 for single. It's 15,750 for head of household. It's 23,650. So most people, I think about 80% of filers use standard deductions, and then it belongs to these categories. But for those people that have properties, yeah, because of the interest on their mortgage loan, insurance they pay on their mortgage loan, and other deductions including medical expenses and charitable contributions. Those ones contributing, assisting religious organizations, they will have to itemize. And the itemization is preferred if the total amount you have as deductions is higher than the amount you have here, and you are filing with your spouse, and the total amount you have that you have to itemize is more than this amount, I will advise that you do itemized deductions. Single filers are also qualified for itemizations as well as the head of household. Yeah, but what actually determines whether you itemize or use the standard deductions is the amount you have from this alternative route. Yeah, that normally comes if you have properties. So I think that's what I have for the update for the 2025. So I'm now open to take questions.
Thank you so much, Mr. Cyril. I know we don't have time, and I'm sure
Yes,
you could go deeper. So we truly appreciate how much time you already gave and all the updates we have for 2026 tax year. So we have a question already in the chat room.
yes.
And also I would encourage others to please drop in your questions. We didn't just come here to learn. Let's also engage Mr. Cyril. So Mr. Godwin mentioned in the chat, he said, how many times can a person claim any of the education tax credits? That's his first question.
Okay. Yes, yeah, for those doing undergraduate, it's four times. So they believe by the end of the 4th year, you would have completed the undergraduate courses. So you can only claim it for a maximum of four times. But if your graduate studies is overlapping with undergraduate year, then that may give you the opportunities to claim it for the 5th year.
Okay, thank you, Mr. Cyril. So the next question is, what is your advice to a couple who just arrived in the US and are working, but one of them plans to attend college? Should they file jointly or head of household?
I will advise them to file jointly. Yeah, because they are able to maximize the standard deductions, which we just discussed there. So if they are filing jointly, and then the total, for example, if one of the spouses work, and the spouse makes 70,000, because they are electing, even though they only one W2, even though they only have one W2 at the end of the year, because they let marry filing joint, what is not going to be taxed out of this 70,000 is going to be 31,500, which is standard deductions for the year. But if only just one of them is filing, yes, that's going to be divided by 2, by half. So that's one of the major advantage. And if they have dependent, because they are electing marry filing joint, the refund that will come to them as a family is going to be higher than just filing alone. Because even if they elect head of household, the head of household standard deduction for head of household is still very much lower compared to what you receive as marry filing joint or under standard deduction.
Okay, thank you for that response, sir. And the next question is, how does your tax return affect your kids' chances of getting financial aid in college? And what can be done to improve their chances regardless of your income?
Yeah. The word regardless of income, that will not be visible. Yeah, because FAFSA will only make determinations for qualifications based on adjusted gross income. So if they depend on W2 income, then they may have to establish business on the side, which can help them to defray their income. So if the income is lower, then the adjusted, if they have, because if they start a business or maybe one of them is driving Uber or Lyft, that will give them the opportunity to claim certain expenses. That expenses will now give them the opportunities to reduce their W2 income. So, and then if that reduction in W2 income may help may result to a situation whereby the adjusted gross income meet the threshold required for them for their ward or dependent to qualify for the FAFSA or meet FAFSA requirement.
Okay, thank you for that, sir. We have more questions.
Yes,
and thank you for your time. So for small business owners in our community, which credits or deductions are often overlooked and could increase their refund? That's the question.
Yes, there are small business credit. For example, if you're a small business owner, that credit has been in place since 2017. If a small business owner, about 20% of that income, 20% of that income is excluded from taxation. So that means you only have the remaining 80. For example, if your business makes 100,000, you have 20% of it. So that means you are left with 80,000. That 80,000, by the time you now deduct business expenses, what do you have left? Is what will be taxed.
Okay, thank you, sir. So the next one says, with the changes coming in 2026, I presume that's what he wanted to say. What should individuals and business owners start preparing for now to avoid surprises during tax season? I know you mentioned some for individuals. So for business owners, what should they start putting together for next year tax season?
Yeah, for them now, for those ones that are receiving the 1099 from a third party, like a PayPal, they just have to wait till the end of the year. And the PayPal, there's likelihood that PayPal or some other third parties that is hosting the 1099 will give you the 1099 towards the end of the end of January. Yeah, but for the business expenses related, there are two ways to it. If you don't have your invoices ready, yeah, you may have to start putting them together. Alternatively, is that your credit card bill and then your bank statement, because most of the spending especially if you have a business account for your business, you have that your business have its own bank account. The income you are receiving is entering into your bank account. The expenses you are spending is also coming out of that bank account. So all you just need to do in simplest form is to print out your bank statement at the end of the year, January through December, and send it to your tax preparer. Yeah, because it would have captured your income and expenses for the year. And if you still have you have credit card account, you also, that one, you pull it out too and print it out. But if you have any other mode of keeping your record, for example, if you use QuickBook, you go to QuickBook and then you print out your profit and loss and balance sheet for the year, and that will be used to prepare your tax return. If you are doing businesses with other partners, then you may have to have the end of the year steering meeting with your partners and decide. If you are changing, especially if you are changing the profit and loss sharing ratios, you discuss it before the year end.
Okay, thank you, sir. So we have more questions. This one says, can I add my mother who just arrived the US with green card as my dependent when filing my taxes?
Yes, you can have your mom as your dependent, but having your mom as a dependent does not give you the kind of refund that somebody who have children under the age of 17 will get. Because at most, if you are adding your mom, the most you can get towards your refund, if you are qualified, is just about $500. And it may be lesser. If your income, you may not even get it if your income is high. But that one will give you the opportunity to claim head of household, because at least you have a dependent. And then the standard deduction that belongs to the head of household, which is about 23,000. So you have the opportunity to get that one, and your exposure to taxes is also minimized.
Thank you, sir. So, we have another question. If my 19-year-old child live in a dorm and I pay the child a monthly salary, can the child file independently, or is it better for me to claim them as dependent?
It all depends. If your 19 years old is working and is also schooling, I will advise, let them file on their own. Yeah, but if your 19 years old is not working, you can still claim your 19 years old in your tax return. It's not as if the presence of your dependent who is 19 years old is going to help in improving your earned income credit or additional child tax credit, because you remember 17 versus 19. That child is no longer eligible for child tax credit. It's not eligible for additional child tax credit. But one other credit that is still available there is the credit for other dependent. So your 19-year-old may qualify as other dependent, and that may help to increase your refund. Or also on top of that, because your 19 years old is attending a college, you are qualified to claim education credit as well on your tax return. That may help to increase your refund or help to reduce your tax liabilities, as the case may be.
Okay, thank you, sir. I don't know if anyone else wants to maybe ask their question verbally, like you want to raise your hand to unmute and ask your question, please, you can do that as well. If you don't want to use the chat box, you can also unmute. We still have a couple of minutes before we round up for today's session. Okay, I think we have another question. I have been paid for 2024 tax refund, and when I called, I was told they are reviewing. Is it I've been paid or I have not been paid? Okay, I've not been paid for 2024 tax refund. And when I called, I was told they are reviewing for 120 days. I called after 120 days. I was told to give another 120 days. I called after 240 days. I was told to wait for another 120 for review. Please, what do you think the issue is?
Yeah, under such conditions, you may have to wait for IRS to make their determinations. Yeah, if they are telling you they are still reviewing it, there's nothing you can actually do. Yeah, they can't really do anything about it. You just keep on calling them. But taxes that are subject to review sometimes, it's not because you have done something wrong. It could just be in the course of refund processing. It's just like you are printing something through the printer. If there's any hiccup in the printers, they remove the one that doesn't follow the process, and then they allow the others to run. So, and then the one that they take out of the systems, they will have to review manually. And because there are so many taxes under such conditions, yes, and awaiting the manual review, it usually takes longer time, sometimes more than a year.
Thank you for that. So another question I would love to ask, there's usually a common tax filing status that most taxpayers would want to use, which is the head of household. And I've seen situations where both couple file separately as head of household using the same address, and some people say it's okay to go that route. Would you like to speak to that a bit?
Yes, if we are living under the same roof, the basic tenet of tax preparations for head of household is that two head of household, especially bearing the same last name, cannot be under the same roof. That is the standard practice. However, if for couple, for example, if somebody is living in, one of the couple is living in Dallas, and Dallas to Odessa is more than 200 miles away, and then another couple is living in, let's say, Midland, both of them can use head of household. For example, if the husband is living in Dallas and have one of the dependents living with him, there's another and then his or partner is living in Odessa having one or two of the dependents. Both of them can claim head of household and still use the same address. Yeah, because of the distance.
Okay. So it's about the distance.
It's about that distance. Yeah, but if they are living under the same household, and then they are circumventing the rule, if they are audited, yes, the consequences can be grave.
Okay. Thank you so much for that. I think we already maxed out our time, and I believe we don't have more questions as at now, but we still have maybe 1 or 2 more minutes if you still want to ask your question before we release Mr. Cyril. Any more question? Okay. In the absence of any question, I think we can draw the curtains from here. Thank you so much, Mr. Cyril. You just gave us Tax 101 in less than an hour. I hope this.
Thank you so much, man. Thank you.
You're
Thank you,
welcome.
everyone.
Thank you.
Yes, so feel free if any question comes to mind later on, please feel free to call me.
Absolutely.
Yeah, feel free to
his
call me.
contact is right there on the screen. You may want to take screenshots or just write something out if you need. We all need tax services as far you're in the US. So in case you want to reach out, please reach out to him for further consultation and questioning. Thank you so much, sir. We appreciate your time. Thank you for pouring out to us in this house, and thank you for being a part of us as well.
Thank you.
It's been a great time, and at this time we say thank you everyone for also taking your time to join when you're supposed to be resting for the weekend or preparing for the new week. We hope you all have a great week ahead and stay blessed.
Thank you. Thank you, everyone. Thank you.
Sir.
Bye.